OpenAI is one failed funding round away from disaster. Sounds wild, right? Almost unbelievable. After all, ChatGPT is everywhere. It's woven into the fabric of our digital lives, from students writing essays to developers coding the next big app. It feels less like a product and more like a utility, as fundamental as a search engine. It feels like the biggest thing in tech, a paradigm shift that has captured the world's imagination and dominated headlines for years. Sam Altman says they are building our future, crafting artificial general intelligence for the benefit of all humanity. The mission is monumental, the ambition is galactic, but behind the hype, behind the promise of a utopian future, is a fragile and incredibly complex financial reality. What if the company shaping tomorrow is built on a business model that can't sustain itself today? What if the very act of using their revolutionary product pushes them closer to the edge? To understand the truth, you have to follow the money, not just the headline-grabbing investment figures, but the relentless, invisible cash burn happening with every single query. The story shifts when you look past the slick user interface and into the vast, power-hungry data centers. This is where cash flows directly into compute. These models are insanely expensive to train, but the real ongoing cost is running them. It's a cost measured in megawatts of power and millions of dollars for specialized hardware. Every query, every generated word, every pixel in an image costs real dollars in electricity and processing time. Every minute, that cost compounds globally. The question isn't if the product is cool or even revolutionary. It is. The real question is whether the unit economics can ever be profitable. Can the business survive the economic headwinds of its own creation? Because that wind is picking up now, threatening to topple the very company that promised to build our tomorrow. Let's keep it simple. Imagine a wildly popular lemonade stand. You made $13 billion last year, but your ingredients cost a fortune. You still lost nearly $8 billion. OpenAI makes a lot, and loses more, and the losses are getting bigger. Some reports project $14 billion lost in 2026. $1 billion a month into the cloud. Compute. Like filling a tub with the drain open. Who covers the gap? Investors. Estimates peg negative cash flow near $143 billion through 2029. Only a small fraction pays. Every free question costs money. Backwards economics. The cost center has one name: compute. But that single word hides a universe of expenses that bleed cash at an unprecedented rate. It's not just about having powerful machines, it's about the relentless ongoing cost of keeping them running. Training a foundational model, and the constant demand of inference both consume massive amounts of power. We're talking about energy footprints comparable to small cities, requiring dedicated power purchase agreements and complex grid infrastructure. This isn't just plugging into a wall, it's a strategic energy operation. GPUs are the workforce, but they're nothing without high-speed networking fabrics to connect them and vast pools of memory to hold the models. Data is the stone, but it's increasingly licensed at a premium from publishers. And the data centers are the sprawling billion-dollar factory sites. NVIDIA currently powers the boom with its sought-after chips, and they aren't cheap. But the dependency runs deeper, creating supply chain bottlenecks for everything from the chips themselves to the substrates they're built on. This scarcity gives suppliers immense pricing power. Cash and electricity. AI's voracious diet. Every query, every generated image, every line of code has a measurable cost in watts and cents. Worse, the incredible scaling gains of the past may be flattening. We're hitting a wall of diminishing returns. Where doubling the compute no longer doubles the performance, forcing companies to spend exponentially more for marginal gains. Even a simple answer takes serious compute. The cost of inference, just running the model for users, is a constant drain. Longer context windows and multimodal inputs like images or audio dramatically increase this per-token cost, making every interaction a financial calculation. So while headlines talk of valuations from $1.4 trillion down to $600 billion, these are still astronomical figures for a company that continues to lose billions of dollars each year. The valuation is a bet on the future, but the burn rate is a reality of the present. The backers are giants, led by Microsoft. Satya Nadella isn't just investing, he's integrating AI into every corner of his empire, creating a powerful symbiotic relationship. And NVIDIA's Jensen Huang doesn't just supply the chips. He masterfully fuels the narrative of inevitable progress, ensuring demand for his hardware remains insatiable. Amazon's multi-billion-dollar commitment made waves, but the numbers were big mostly on paper, riddled with conditions. Much of this funding is conditional, structured as installment-based tranches. This is not a blank check, it's a leash. If performance targets or revenue milestones are missed, the next tranche of cash is put at risk. This structure fosters a deep, almost existential dependence on the backers. Some tranches are even tied to audacious, long-shot goals like achieving artificial general intelligence or a successful IPO, both monumental uncertainties that place the company's fate in the hands of its investors' patience. In the high-stakes world of artificial intelligence, a peculiar financial mechanism has emerged, one that bends the normal rules of market economics. It's a strange, self-referential loop known as circular funding. On the surface, it looks like a brilliant strategy to accelerate an industry. But dig a little deeper, and you find a fragile system built on a series of interdependent promises. The cycle begins when a dominant supplier, often a chip maker, doesn't just sell its product, it invests directly in its own customers. By taking an equity stake in the very startups that need its hardware, the supplier plays a dual role, vendor and venture capitalist. This infusion of cash gives the startup the capital it needs to place massive orders for that supplier's products. But the support doesn't stop there. To help these young companies acquire fleets of expensive servers, the supplier even backstops their hardware leases. This means they guarantee the lease payments to the financing companies, effectively removing the risk for lenders and enabling startups with little revenue to secure millions in hardware. It's a critical lubricant that keeps the gears of the loop turning. The circle closes with another commitment. The supplier also agrees to purchase cloud computing capacity from these same customers once their platforms are operational. This prearranged demand provides the startup with a guaranteed revenue stream, which in turn helps them justify buying even more GPUs. The investment money flows from the supplier to the startup and right back to the supplier's top line as product revenue. For a time, everyone wins. The startup gets the capital and hardware it needs to build. The supplier books massive sales, its revenue figures soaring. This inflates the optics for Wall Street, creating a powerful narrative of unstoppable growth, until it doesn't. This circular system is inherently unstable. It masks the true, organic demand for a startup's services, creating an artificial economy. If the startup fails to find real, paying customers beyond its own investor, the loop breaks. The revenue vanishes, the lease guarantees are called in, and the whole house of cards falls. Because in the end, healthy, sustainable markets don't need to be propped up by supplier subsidies. Real demand is the only true measure of success, and we see that real demand building elsewhere. Google pushes its Gemini models at enterprise scale, where the unforgiving gravity of cost still applies. Musk's xAI ships Grok to paying subscribers. Compute isn't free there either. GPT-era integrations are appearing everywhere, but so are the bills for running them. The pressure to find sustainable business models is immense. And now, we see the first signs of that pressure valve being released, ads appearing in AI apps. The titans of tech are all in, chasing the dream of artificial general intelligence. But no matter how grand the ambition, the fundamental physics of money still rule. The meter is always running, and eventually every company must prove it can stand on its own. OpenAI began testing ads in the free tier, a move once framed as a last resort. Quick revenue, but UX cost. Spending goals quietly halved, because partners balked at the math. Feels reactive, not resolute. Competitors reportedly rate limit to save compute. Core providers grew revenue, yet margins collapsed. OpenAI is load-bearing for an ecosystem. If it stumbles, many wobble. This isn't anti-AI, it's pro-reality. Ignore hype, read the ledger. Every dollar must be justified now, and the clock is ticking. A massive lawsuit adds risk. Musk seeks staggering damages. A trial advances, costly and distracting. OpenAI warns partners to brace. Microsoft is deeply tied, too big to let fail. Likely outcomes, bankruptcy or absorption. If absorbed, the tech lives, brand doesn't. Watch revenue, losses, burn rate. Next round, how much, who backs, what terms. More ads or paywalls, shucks and strain signs. If suppliers' margins sink, pressure spreads. Stay cautious and curious. OpenAI can cross, or fall. The signals will tell you before the headline does.